The Fed's 20 bips hike was largely in line with market expectations. However, the Fed also delivered some significant positive surprises on the rate hike trajectory. The US Central Bank's Rate Setting Committee, that is, the FOMC, introduced a shift in its policy statement as it moved away from using ongoing increases to the policy rate to needing some additional firming. Besides, the FOMC median forecast showed that the Fed is likely to hike rates just one more time this calendar year. It left the terminal rate, or the rate at which its benchmark Fed funds rate will peak, unchanged at 5.1% from the last estimate in December. Investors read this as a dovish signal and expect that the rate hike cycle is nearing its end. The US Fed has ruled out rate cuts this year. Markets are still betting that the rate cuts could begin in the second half of 2023 itself.
This outcome clearly gives us a sign that the future for interest rate hikes are going to be softer, and there is a pause coming in the future as well. Though Fed was very clear that in the next year there would be no rate declines, the market seems to believe that the rate would decline, especially in the second half of the year. Having said that, it is fair to assume a little bit of interest rate hike in the next quarter. And the reason behind this being US inflation. Fed is playing a thin line between managing inflation and the economic downturn, but inflation levels in US at 4.7% is way higher than what they wanted to be at about 2%. What are the bond markets saying? The US 2-year and 10-year interest rate yields have both come down from a peak for the 2 years at 5% to about 3.8%, and for the 10% from a peak of about 4% to about 3.4%. So these two clearly have suggested that whatever level of recession US was expecting, that rate is probably going to be a little lower.
Meanwhile, experts expect the RBI to follow in the US Fed's footsteps and deliver an interest rate hike of 25 bips in April, though they believe that a pause in the rate cycle will likely follow post the upcoming meeting. With the headline CPI print tracking above 6% for January and February, we build in an additional rate hike of 25 bips by the RBI in its April policy review, as we peg the terminal rate at 6.75%. Further, the inflation trajectory is likely to decelerate from the quarter ending June, which will preempt the RBI to pause the rate hike cycle. As such, risks to monetary policy will be contingent on expectations of inflation trajectory and external factors such as global financial conditions and trend in commodity prices. Sharing similar views, Nishchal Maheshwari of Centrum Broking remains upbeat on the domestic economy and suggests investors build positions using the current weakness. He believes that the inflation is not a major concern for the Indian economy.
So I think basically RBI may not take a rate hike at all. We have seen rupee being pretty stable. Inflation at our end is not so sticky. So we do not have a very big problem as far as inflation is concerned. So there may be a chance that RBI may do a 10 basis point more of just a representation kind of a thing, rather than actually trying to, and maybe or possibly just skip it altogether. So I think it's now becoming time to buy the dips actually in the market at 17,000. So my broad thought is basically that Nifty will do 1,000 rupees of earning for FY24, and long-term averages have been around 16 and a half. So I think from here to 16,500, I would be comfortable buying the dips in the market. So domestic consumption is the things basically which I've been favoring, given that you have so much turmoil internationally. And if the rates remain higher for longer, I'm very sure basically it's going to lead to maybe a mild to a medium recession in the US. So when in this kind of a background, I think it's best to avoid all international facing sectors. Good to look at the domestic consumption sectors. Banking is our top pick, FMCG, pharma, then cement, construction. These are some of the sectors basically which we like. I think something like 18,500 is what we believe basically Nifty should be there by the end of the year. If the third quarter in the US basically of calendar year faces a recession, if it goes to the fourth year, then you might see a lower number actually.
Hence, equity markets are expected to pin their hopes on the US Fed's softened stance on its aggressive monetary tightening. However, whether the RBI will toe the US central bank's line remains a crucial trigger in dictating the market trend ahead.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.